So next heading in your notes, long-term liabilities. Long-term can also be referred to as non-current. So it would mean the same thing. Long-term liabilities or non-current liabilities. This topic at CFA Level 1 is divided into 3 parts. The first part is accounting for bond liability. So when an organization issues bonds, that's a liability. And then how do you account for that? So that is the first part of the reading. Second part, accounting for leases. So when you lease an asset, then how do you account for that particular transaction in the books of account is accounting for leases. And in the last part, which is theory of pension liabilities. So for level 1 exams, we have to look at how to perform accounting for the first 2 areas, bond liabilities and leases. For the pension liability, we would be learning the accounting at CFA level 2. As long as level 1 is concerned, you just have to understand the economics in terms of how it works and how liabilities are recognized. So we would follow it in the same sequence. So the next heading that will come in your notes, accounting for long-term or accounting for bonds. We should rather say accounting for bond liability. We will write 2 sentences. The first one, market value of a bond. Market value of a bond is present value of future cash flows. Present value of future cash flows discounted at current YTM. So we have seen this sentence multiple times so far. There is some reference in corporate finance when we calculate YTM. And of course, we have to do this in fixed income again. In this sentence, you have to underline 2 words. The first one, market value. And second, current YTM. Okay, so when you want to calculate market value, you are going to use current YTM. Let's write the next sentence. Book value of bond liability is present value of future cash flow discounted at YTM on the date of issuance. So in this sentence, we will underline the word book value. In fact, maybe the whole part, book value of bond liability. And then we will underline YTM on the date of issuance. Let's do a numerical to understand what is the difference between these 2 sentences. Let's first try to link it with something we have already learned. Let us say an organization started a new business. To start that business, they raised equity capital, 100. Then they issued bonds. So when they issued bonds from investors, they collected 200. So this bond is now a liability. Using this money, they purchased, let's say a building, just a hypothetical scenario of 300. Now by the end of the year, this 300 worth of building in the market has become 350. At what price will we recognize this building in the books of account? Will we recognize at 300 or 350? We will recognize at 300 because we use historical cost accounting. Okay, since our intention is to hold on to that building for next 10, 15, 20, 25 years, therefore we would not worry about market prices. In the same fashion, the market value of the bond will keep on changing every day. So by the end of the year, market value of this bond was 175. But what organization will say is that we have raised 200, we have to pay back 200 few years from now. So we would not consider what is the market value of the bond. And that is why the second sentence, that the book value of bond liability is a function of YTM on the date of issuance, not the YTM that keeps on fluctuating in the market. Is that making sense? Let's do a numerical now. Let us say face value of a bond is 1000. Coupon rate is 10%. Maturity is 5 years. Okay, so I'm plotting it on the timeline. Let's look at what are the cash flows. This is time 0. This is time 5. Cash flows, what do you think? What would be the cash flow in year 1? 100. That is 1000 into 10%. So 100, 100, 100 and 100. And cash flow in the last year would be additional 1000. Now, this YTM is to be thought of as the interest rate that exists in the market. So YTM, the YTM at time 0 was 15%. Now, is it necessary that this YTM will remain constant throughout the period of 5 years? No, it would fluctuate based on demand and supply functions. So this YTM is simply the market interest rate. So by the end of year 1, it had become 12%. Then it became 8%, 6%, 15%. I'm just exaggerating it a little bit, and let's say 17%. So this YTM kept on changing every day. Using this YTM, we can calculate the market values. So this is where you will use the first sentence. Market value of a bond is present value of future cash flow discounted at current YTM. So let's find out what would be the market value at time 0. Second clear TVM. 100 payment, 1000 future value, 5N, 15 IY, compute present value. 832. Now, this bond is trading at a price which is less than 1000. Do you agree? Why? Because the bond is offering a coupon only of 10, but the market rate is 15. And whenever the bond offers a coupon lesser than the market rate, the bond is said to be issued at a discount. Now understand this carefully. Next year, the number of remaining cash flows will be only 4. Correct? So what I want you to do is, currently 5 is saved as N in your calculator. Just override that with 4. So say 4 as N. But what is the current YTM now? 12. So say 12 is IY. 4 is 8, 12 is IY. Compute present value. 939. Then say 3 as N, 8 as IY. 3 as N, 8 is IY. 1051. 6 as IY, 2 as N. 1073. 15 is IY, 1 is N. 956. And 17 is IY, 0 is N. 1000. So the N on the last date doesn't really matter, because that's the maturity of the bond. However, in this topic, we don't have to really worry about the market values. Okay, so this data for us is technically irrelevant. Since we are accounting for bonds, we would not really be considering how the bond price fluctuates in the market. What we want to consider is what is the amount of liability that would be shown in the books of account. And the only YTM that's relevant for us is the YTM on the date of issuance, which is 15%. So let us calculate the book value of bond liability. So second clear TVM, 100 payment, 1000 future value, 15 IY, 5 as N, compute present value. 832. So at time 0, the market value and book value would be same. It has to be, because that's the money that company will receive from the investors. Now next year, just make 4 as N, but the IY will remain same. So say 4 as N, 857. Then 3 as N, 885. 2 as N, 1 as N, 956, and then 1000. So this is the amount at which the bond liability would be reflected in your books of account. Are we okay with this? So the one important sentence that will help you solve all the questions on this reading or this section is book value of bond liability is present value of future cash flow discounted at YTM on the date of issuance. Now, this is one of those topics where there could be a lot of analytical questions. So it's very unlikely that you would be solving questions on numbers, but you would basically be solving if the bond is issued at discount, then what will happen to the bond liability every year, or what will happen to the interest expense every year. So there are 3 signs that you have to remember. So this part you can make. And if you remember these 3 signs, you would be able to solve every possible question on this section. So a par bond, discount bond, and a premium bond. For par bond, you have to remember this particular arrow. So if you remember the shape of this arrow, you can solve each and every possible question on this section. For discount bond, you have to remember this shape of the arrow. And for premium bond, you have to remember a downward sloping arrow. Can you remember this? Good, that's impressive. So let's do an example for each one of them. Let's start with the par bond first. So example number 1. Face value 1000. Coupon rate 10%. YTM on issuance 10%. Maturity 4 years. So now we have to find out what would happen to the bond liability every year. So this is our arrow. Let us first write down what would be the cash flows. So this is time 0, this is 1, 2, 3, and this is time 4. The cash flows we are looking at time 1, the cash flow would be of 100, 100, 100, 100 and 1000. We want to calculate bond liability. So value of bond liability is present value of future cash flow discounted at YTM on the rate of issuance. And since coupon and YTM is same, tell me how much would be the bond liability? 1000. Second year, 1000. For each of the year, bond liability would be 1000. And therefore the straight arrow, that bond liability is not going to change. For every year it is going to remain constant. What would be the coupon cash flow? Coupon cash outflow. Every year, how much will you pay to the investor? 100. So coupon cash outflow is 100, 100, 100 and 100. I'm not considering the repayment of principal, only the coupon. And what would be the interest expenditure? Interest expenditure for each of the year would also be 100. So when a bond is issued at par, your interest expense and the amount of coupon that we pay is going to remain same. Should we go ahead? Now example number 2. Face value 1000. Coupon rate 10%, YTM 25%, maturity 4 years. Now prima facie, just by looking at this data, what do you think? Is it a premium bond or discount bond? Discount bond. The easiest way to think of this is that this is what investors get, the coupon rate. And then you ask yourself that are we getting more or are we getting less? In this case, we are getting less. And because we are getting less, it has to be a discount bond. So discount bond, the shape of the arrow that we decided was upward sloping. So this is how your data is going to behave. So this is time 0, 1 and 4. Step number 1, let us calculate bond liability. Bond liability. So second clear TVM, in fact let me plot cash flows first. 100, 100, 100, 100 and 1000. 1000. Second clear TVM, 100 payment, 1000 future value, 4N, 25 IY. 645. Then just make 3 as N, compute present value. 707. 2 as N, compute present value. 784. 1 is N, present value. 880. And 0 is N. So every year your bond liability is going to increase. Now let us calculate the interest expenditure, the most important part of this reading. Now it will take some time, so I want you to be focused and understand this carefully. My first question to you. You are the investor in this bond. Coupon is 10, but whereas the market rate of 25. My question to you is, how much is it you're earning every year from investment in this bond? 10% or 25%? As an investor, how much are you earning every year? Are you earning 10% or 25%? How many of you feel 10%? How many of you feel 25? Okay. So, a eureka moment for a lot of people. No matter what is the coupon rate offered, an investor will always earn what was the YTM on the date of issuance as long as he holds the bond till maturity. See why? Did you give 1000 or 645? 645. But you are getting 10% on 1000, which means technically you are earning about 100 as a ratio to 645. So how much is that? 100 as a ratio to 645 is how much? 15%. But is this the only earning you have? No, because your 645 in 4 years is becoming 1000. So you are earning that additional 355 as well, right? Because they took 645, they are going to give you 1000. So you are earning that 355, but roughly in how many years? 4 years. So how much per year? Is it about 87, 88? 88. So every year, approximately, not the exact calculation, your earning is happening from two fronts. One, company came and gave you cash in the form of coupon. Second, value of your bond is increasing every year. So you're earning about 188 as a ratio to 645. How much is that? 29%. So these are your approximate calculations. What is the actual calculation now? Let's look at the actual calculations now. So maybe I'll just plot it horizontally. Let's do it here itself. First year, we received a coupon of 100 plus we earned from one more source An asset which was 645 of the investor became 707. Or to the company, a liability which was 645, that liability became how much? 707. So that's an increase in liability of how much? 62. So total earning to the investor and total expense to the company is 162. Are you following this? And 162 on an investment of how much? 645. Let's find out how much is that. 162 as a ratio to 645. That would be precisely 25%. Are you following this? Even though your interest income is 162, how much did you receive in cash? 100. Company said 62 we will just keep on adding to the value of your asset like a zero coupon bond. So any discount bond is essentially a combination of coupon bond plus zero coupon bond. Every year you receive some cash plus the value of your investment keeps on increasing. Is that making sense? Next year your earning is 100 plus. Now this year 707 became 784. Or for company 707 liability became 784. So that is how much? 77. And now calculate 177 as a ratio to 707. 25%. Year after that, 100 plus 784 became 780. That is 96. So total 196 as a ratio to 784. 25. And again in the last year, 880 became 1000. So that is 220 again as a ratio of 880 is 25%. And the last section, which is cash outflow, interest cash outflow. So company in its financial statement in the first year will report an expenditure of 162. But how much cash will go out? 100. For each of the year, the cash that's going to go out is 100. Which means your interest expense is going to be more than the amount of cash that's going out. And will it be okay to say that that 62 is a non-cash expense? Is it a non-cash expense? Yes. See, it's very simple. Okay, it looks very fancy right now. But what has happened is, you went to a person, you said, please give me a loan of 645. Interest rate, he said, I will pay you 25%. So first year, the interest that you were supposed to pay is 162. But you don't have cash of 162. So what you tell him is, take this cash of 100, 62 add it back to your loan. So your loan of 645 became 707. So next year, 707, interest 25%. Total comes out to be 177. You give him cash of only 100, 77 gets added to the loan. And then it keeps on increasing in this fashion in such a way that by the end of year 4, outstanding loan becomes 1000. Intuitive? Example. Yes, interest cash outflow. This one. That every year how much cash are we giving? Just 100. Example number 3. Now this time it's a premium bond. So face value 1000. Coupon 10%. YTM 4%. Maturity 4 years. Tell me, what is the shape? Downward sloping. So this is your premium bond. Let's look at the cash flows first. At time 1, the cash flow would be of 100, time 200, time 300, time 400, plus a cash flow of 1000. Let us calculate the bond liabilities. So bond liability for each of the year. Second clear TVM, 1000 future value, 100 payment, 4 IY, 4N, 1217. So at time 0, it would be 1217 bond liability. Then just say 3 as n and find out what is the liability at time 1. How much? 1166. Then time 2. 1113. Then at time 3. And of course, the last year it has to be 1000. Is your liability decreasing every year? Yes. Now my question to you is, coupon rate is 10%, YTM is 4%, you're an investor, how much are you earning every year? 4% or 6% or 10%? You're earning 4%. Again, no matter what the coupon rate is, investor will earn YTM on the rate of issuance and the company will incur a cost equal to YTM on the rate of issuance. Now, prima facie, it would look like an attractive bond because coupon is 10, but the YTM is 4, which means market rate is 4. Imagine now, market rate of interest is only 4. A company comes out of a sudden, it says we will pay 10% coupon. That means 2.5 times more. Even though they are paying 10%, essentially investors are going to earn only 4. Why? Because company did not take 1000 from you, they have taken 1217. And at the end of year 4, how much are they going to give back? 1000. So essentially, they have taken 217 extra from you. And the same 217, they are going to give you in the form of coupon. So that coupon of 100 that you receive every year, some part of that coupon is your own money given back to you. Is that making sense? So let us calculate the interest expense for each of the year. So first year, of course, the cash that we received and the cash that company gave was 100. But your investment, which was worth 1217, now it is worth how much? 1166. So the value of your investment decreased by how much? 51. So essentially, how much have you earned? You have earned only 49. And calculate 49 as a ratio to 1217. 4%. So that means you have earned only 4% on this investment. So see now what happened is, you go to this organization, you give them 1217. First year they give you 100. First year they give you 100 in the form of cash. You feel very happy. But what you didn't realize is, out of that 100, 51 was your own money. Because your 1217 asset they made 1166. Right? So essentially you're earning only 49 for investment, and that's 4% of the size of investment. Second year, again you would receive 100, but your investment, which was 1166, now it's 1113. It reduced by how much? 53. So 53 was your own money out of that 100. So you have earned only 47, and 47 as a ratio to opening investment 1166. Again, this is going to be 4%. Next year, 100 minus 56, and then you have earned 44, which would again be 4%. And last year, 100 minus 57, you have earned 43, which would again be 4%. Have you understood this? Where is the risk involved in this? This bond, the question Sanchit asked, then where is the risk involved? An investor can take any bond. He will always earn YTM on the rate of issuance. This bond, it is classified as which type of investment? At level 1, you have equity, derivative, alternative investments and fixed income. So bonds are called what? Fixed income. Why are they called fixed income? Because if you buy the bond and if you hold it on till the maturity, your amount of income that you're going to earn is fixed. It is not going to change. However, what if you sell the bond here? Then of course you will not be able to sell it at 1113. You would sell it at market price, isn't it? And then there would be some amount of risk, because either you can sell it at a higher price or lesser price. But if you keep on holding the bond from time 0 till time 4, then the return that you're going to earn, assuming no default, is yield to maturity. That is why it's called yield to maturity. Are you fine with this? Yeah, good. The question she's asked is, what is the cash outflow here? So every year, how much is the cash going out? 100. So interest cash outflow, which I completely missed on. 100, 100, 100 and 100. The cash that's going out. We are not giving interest of 49. We are giving cash of 49. Sorry. We are giving cash of 100. But out of that 100, 51 is investors' own money. So the expense is 49, but cash going out is 100. And can we say that in a premium bond, interest expense is less than the cash outflow? Yes. Interest expense would be less than cash outflow. So now let's see what kind of questions are we looking at on this reading. So let's prepare this summary. So left hand side we will have the discount bonds. Right hand side we will have the premium bonds. We would be writing some high probability sentences, and each of this sentence, which is highly testable, will come to you automatically if you remember those three shapes: straight arrow, upward sloping and downward sloping. So sentence number 1, in a discount bond, bond liability increases every year, and in bracket a upward sloping arrow. So if you know the arrow, you don't need to remember this. For a premium bond, bond liability decreases every year, in bracket downward sloping arrow. Second, because your bond liability is increasing every year, if your liabilities increase, interest expense will increase. Interest expense will increase every year. Upward sloping arrow. Interest expense in the premium section will decrease every year. Downward sloping arrow. Third, interest expense calculation. Interest expense calculation. There are two formulas. The first formula is same in both the sections, premium as well discount. First formula is opening liability into YTM on issuance. Opening liability into YTM on issuance. Okay, so open up your downward sloping arrow example. What is the liability in the discount bond first year? The downward sloping example that we did, bond issued at discount. Sorry, I meant bond issued at premium. What was the liability in the first year? 1217. What was YTM on issuance? 4%. So 1217 into 4%, how much? 49. Is it matching with the interest expense in the first year? Yes. So opening liability into YTM on issuance, this method will work at both the places. Second, discount, coupon paid. Now how can you imagine this? Is the liability increasing every year in discount bond? In a discount bond, is the liability increasing every year? Is that increase in liability an expenditure? Yes. So your expenditure is going to be coupon paid plus the increase in liability, and that increase in liability is called amortization of discount. Okay, fancy term, but what it simply means is that your discount is getting reduced, the liability is increasing. Coupon paid plus amortization of discount. Is this fine? On this side, coupon paid, and what is happening to your liability? Decreasing. So we will say minus amortization of premium. And point number 4, that in a discount bond, coupon paid would be less than interest expense. And in case of premium bond, coupon paid would be more than interest expense. So open up any of the example. Let's say open up an example for discount bond. What is the expense for year 2? In our example, what was the expense for year 2? 177. But what was the cash outflow? 100. In case of premium bond, what was the expense for year 2? And what was the coupon paid? 100. So in case of premium, coupon paid would be higher, and you can very easily link point number 4 to this formula, that it is coupon paid plus, and therefore interest expense is going to be higher. This is coupon paid minus, and therefore interest expense is going to be lower. Are we doing fine?